or wherever you are, and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets with a view to helping you better understand how the markets operate so that you can make informed investment decisions. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 187, and in this episode we are reviewing the performance of the financial markets during the 47th week of 2025, and that is from Monday the 17th to Friday the 21st of November. And without further ado, this is your host, Jamuhuri, and together, let's dive right in. We kick it off in the United States, where, according to a long-awaited report from the Bureau of Labor Statistics that was released on Thursday, the U.S. economy added substantially more jobs than expected in the month of September. Non-farm payrolls increased by 119,000 in September, up from the 4,000 jobs that were lost in the month of August, following a downward revision. This number was in contrast with the Dow Jones Consensus estimate for September, which was at 50,000 jobs. The Bureau of Labor Statistics also indicated that the unemployment rate edged higher to 4.4% in September, which was the highest it's been since October 2021. The release of the employment report brings to an end a data blackout that began in early September and continued through the record-breaking government shutdown, which lasted 44 days. The September jobs report shows that the U.S. labor market remained resilient before the government shutdown, but there are some concerns about the job losses in August and the increase in the unemployment rate. In related news, the Bureau of Labor Statistics also announced that it was canceling the release of the Consumer Price Index for the month of October, leaving the Federal Reserve without a key piece of inflation data ahead of its scheduled policy meeting that is set for the 9th and 10th of December. The CPI data, which was previously scheduled to be released on the 7th of November, was cancelled because the government shutdown made it impossible to retroactively collect certain survey data. In addition to that, November's Consumer Price Index, which was scheduled to be released on the 10th of December, will now be released on the 18th of December after the Fed's policy decision. Staying stateside, the minutes of the Fed's October policy meeting were released on Wednesday and showed that Federal Reserve officials were divided over cutting interest rates and also on whether a stalling labor market or stubborn inflation was the bigger threat to the U.S. economy. While the Federal Open Market Committee approved a rate cut in October, the path forward for monetary policy was less certain. Several participants assessed that if the economy evolved as they had projected, then a further rate cut would be appropriate in December. However, other participants suggested that under their economic outlook, it would be appropriate to keep the policy rate unchanged for the rest of the year. Over to the Far East, where on Friday, Japan's cabinet approved a stimulus package totaling to about $135 billion as Prime Minister Sanae Takaichi sought to boost the country's slowing economy and to offer support to consumers who were feeling the pinch of inflation. According to local media, this stimulus package is the largest since the COVID-19 pandemic. Data released on Friday showed that Japan's core rate of inflation for the month of October rose at its sharpest rate since July, supporting the case for a hike in interest rates by the Bank of Japan. The core rate of inflation, which strips out the price of fresh food, came in at 3% flat, which was in line with market expectations, but still remains above the Bank of Japan's target rate of 2%. On Wall Street this past week, U.S. equities rebounded on Friday after New York Federal Reserve President John Williams suggested that the central bank could cut interest rates at its last policy meeting this year. The comments signaled to investors that the Federal Reserve is likely to lower its benchmark borrowing rate at its upcoming policy meeting in December. This led traders to raise bets that the Fed would in fact cut interest rates for the third time in 2025. According to the CME's Fed Watch tool, the Fed funds futures are currently pricing in more than a 70% chance for a quarter percentage point rate cut in December. Despite Friday's rebound, all the three major averages were still headed for big losses this past week, with the S&P 500 falling by more than 1% during the week to close at 6,602, whilst the Dow Jones Industrial Average declined by a similar margin of 1% to end the session at 46,245, and the tech-heavy Nasdaq Composite shed around 2% during the week before finally settling at 22,273. In the government bond market, Treasury yields were lower on Friday after New York Fed President John Williams offered some hope to investors that the Federal Reserve may reduce its key policy rate at its final meeting of 2025. Williams said that the Fed is able to cut rates again, adding that monetary policy has become somewhat less restrictive, especially since the central bank approved rate cuts at its previous policy meetings in September and October. As mentioned earlier, according to the CME's Fed Watch tool, the Fed funds futures are now pricing in about a 70% likelihood for a rate cut in December. In response, the yield on the 2-year Treasury note shed more than 2 basis points to close at 3.53%, whilst the yield on the benchmark 10-year Treasury bond also fell by more than 2 basis points to settle at 4.08%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the commodity markets, the price of crude oil extended its decline and energy stocks fell sharply on Friday as President Trump pushed for a peace deal to end the long-running war between Russia and Ukraine. The bearish market sentiment comes as investors pored over the details of the peace deal, which reportedly proposes that Ukraine cede land to Russia and to also pledge that it would never join the NATO military alliance. And in response, the price of the international benchmark Brent crude slipped by 2.2% on Friday to settle at $62 a barrel, whilst the U.S. benchmark West Texas Intermediate crude was last seen trading lower by 2.6% as it came to a close at $57.46 per barrel. In the precious metals market, the price of gold pared losses on Friday after falling over 1% earlier in the session as traders boosted bets for a December rate cut following dovish comments by a senior Fed official. On Friday, New York Fed President said that the U.S. Central Bank could still cut interest rates in the near term without jeopardizing its target of maintaining inflation at around 2%. Meanwhile, other Fed officials maintained a hawkish stance, with the Dallas Federal Reserve President calling for the Fed to leave the policy rate on hold for a time. Traders are now pricing in about a 70% chance for a rate cut in December, but are also keeping a close eye on the U.S. stock market because if it continues to rally as it has done previously, then that could put some downward pressure on gold because of the improved risk appetite in the markets. For your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. After falling more than 1% earlier in the session, the price of spot gold was on track for a weekly loss of just 0.2% as it eventually came to a close at $4,065 per ounce. In the cryptocurrency market, the price of Bitcoin continued its freefall this past week as it tumbled as much as 6% on Friday morning and was hovering just above a key support level of $80,000 as investors continued their flight from riskier assets to more traditional and defensive assets. Bitcoin's slide follows mounting pressure in the U.S. stock market, which has led many investors to shift away from volatile assets like crypto and artificial intelligence stocks into safe haven assets such as gold. Bitcoin's decline was initially ignited by a widespread liquidation of highly leveraged crypto positions in the month of October. However, this downturn worsened during this past week as the price of Bitcoin hit its lowest level since April as it hovered around $80,500 per coin. According to CoinMetrics, the price of Bitcoin fell by 12% this past week and by about 26% over the past 1 month, and was last seen trading at around $82,900 per coin. We now change scene to the Kenyan financial markets, and we start by looking at the domestic foreign exchange market, where the Kenya shilling has finally started to show signs of active trading as it depreciated marginally versus the US dollar this past week. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at a rate of 129.96, and this is compared to 129.25 the previous week. Meanwhile, the sterling pound was priced at 169.67, and the euro was valued at 149.68. And on the regional front, one Kenyan shilling was changing hands for 28.01 Ugandan shillings and 18.62 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.19. The International Monetary Fund has raised concerns about the stability of the Kenyan shilling, and in response, the central bank confirms that it continues to adopt a floating exchange rate policy. However, the data appears to tell a different story, as the dollar-shilling rate has been stuck at between 129 to 130 shillings over the past 2 years, and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the Kenyan shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product, and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves recorded a significant decline of $283 million for a grand total of $12 billion, which is equivalent to 5.2 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this massive position, Kenya's foreign exchange reserves still remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports, and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market remained sufficiently liquid and was also supported by the central bank through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenyan shilling overnight interbank average, aka Kesonia, this is the rate that banks use to lend to each other and is now the new reference rate for all lending transactions by commercial banks. The overnight interbank rate was stable at 9.25%, and remains pretty much in line with the central bank rate, which is also at 9.25%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this amount stood at 17.2 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 20th of November, and the central bank received bids totaling to 43.4 billion shillings. against an advertised amount of 24 billion shillings, representing a performance rate of about 180%. The central bank ended up accepting almost the entire amount, and the results of the auction were as follows. The 91-day rate was stable at 7.78%, whilst the 182-day rate ticked up marginally to settle at 7.80%, and the 364-day rate rose by 2 basis points to average out at 9.37%. In the primary bond market, the auction for the November bond issue was held on Wednesday, the 19th of November, and the Central Bank of Kenya received bids totaling to 115 billion shillings against an advertised amount of 40 billion shillings, representing a performance rate of 289%. The central bank ended up accepting 54.7 billion shillings, and the results of the auction were as follows. For the first bond, which is a 15-year bond that was initially issued in 2019 and now has 8.7 years left to maturity, the central bank accepted 20.1 billion shillings at a weighted average rate of 12.57% compared to the bond's coupon rate at 12.34%. And for the second bond, which is a 25-year bond that was initially issued in 2022 and now has 21.9 years left to maturity, the central bank accepted a 34.5 billion shillings at a weighted average rate of 13.74% compared to the bond's coupon rate at 14.18%. In related news, Safaricom has received regulatory approval to issue a 40 billion shilling corporate bond for the purpose of infrastructure upgrades in Kenya and Ethiopia, with a view to broadening its 4G and 5G networks. This will be the largest corporate bond to be listed at the Nairobi Securities Exchange and is a major boost to Kenya's corporate bond market, especially coming soon after East African breweries raised about 16.7 billion shillings from the market. This bond will be issued in tranches, and the first tranche will be issued after the finer details, such as the price and the tenor of the bond, are approved by the Capital Markets Authority. At the Nairobi Securities Exchange, during the past week, all the four major indices recorded mixed signals, with the NASI registering a marginal gain of 0.26%, whilst the other indices were in negative territory, with the NSE 10 losing the most by 0.9%. The stock market performance was mainly driven by losses recorded by large cap stocks such as Crown Paints, Umeme Limited, and Absa Bank, which declined by 11.5%, 10.6%, and 8.4% respectively. This performance was, however, supported by gains recorded by other large cap stocks such as Uchumi Supermarkets, which increased by a massive 54.1%, whilst East African Portland Cement and Olympia Capital increased in value by 10.7% and 7.5% respectively. During the past week, market capitalization increased by 0.26% for a valuation of 2.965 trillion shillings, whilst the equity turnover increased by 6.1% for a total of 3.83 billion shillings. Meanwhile, foreign investors were net sellers during the week with a net selling position of 834 million shillings. In related news, Zenith Bank, which is Nigeria's second largest bank by asset base and market capitalization, is seeking to acquire Kenya's Paramount Bank and has sought regulatory approval to proceed with the transaction. The plan by Zenith Bank to enter the Kenyan market through an acquisition had been reported earlier in the year, but the target bank at the time had not been identified. According to the Business Daily, Zenith Bank is at an advanced stage in terms of securing approval from the central bank in order to proceed and complete the acquisition of Paramount Bank. Up next is our topical issue, and this week we are looking at banks' liquidity ratios and the trend in private sector lending. Commercial banks in Kenya are holding record levels of cash reserves, mainly due to a slowdown in private sector lending. Despite regulatory pressure to reduce interest rates and increase lending to the private sector, the challenging economic environment has led to increased loan defaults. As at the end of August 2025, the average liquidity ratio for commercial banks hit a record high of 59.8%, which is significantly higher than the central bank's statutory minimum of 20%. For your information, the liquidity ratio stipulates the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. Meanwhile, the ratio of loans to customer deposits has shrunk from a peak of 85% down to 71%, which means that banks are now much slower at converting customer deposits into loans. In August 2025, customer deposits were recorded at 5.89 trillion shillings, whilst customer loans were valued at 4.16 trillion shillings. The data shows that customer deposits grew at a faster rate of 4.7% compared to the customer loan book, which grew at a slower pace of 3%, and this further contributed to the higher liquidity ratios in the banking sector. The main reason for the cautious lending by commercial banks was attributed to the high rate of loan defaults. And as of August 2025, the total stock of non-performing loans hit a new record high of 732 billion shillings, representing about 17.6% of the total loan book in the entire banking sector. The Central Bank of Kenya has been actively trying to encourage lending to the private sector in order to spur economic activity and growth. The central bank has urged commercial banks to lower their interest rates and pass on the benefits of monetary policy decisions to the public. The central bank has made 8 consecutive rate cuts, bringing the central bank rate from 13% in August 2024 down to the current rate of 9.25%. In February this year, the central bank also reduced the cash reserve ratio from 4.25% down to 3.25%, which released an additional 35.2 billion shillings for banks to on-lend to their customers. The average lending rates have dropped from 17.22% at the start of this year down to the current rate of 15.07% as at the end of September. However, despite these initiatives, credit growth remains much lower than expected. Despite the slow growth in customer loans, bank profitability recorded an annual growth of 12.3% for a total of 203 billion shillings in the 8 months to August 2025. This growth was due to wider interest margins as the cost of deposits fell faster than the price of loans. The gap between what commercial banks charge for loans and what they pay for deposits is currently sitting at a 9-year high of 7.44 percentage points. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if that is the case, please share this podcast with your family and friends and help to keep them informed of the latest developments in the financial markets so that they can also make informed investment decisions. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major distribution channels such as Apple Podcasts, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address. That is jamuhuri@gmail.com. Jamuhuri spelled JAMUHURI. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, the only limits you have are the limits you believe about yourself. Think about it. Thank you, and God bless.